I start from the position espoused by Paul Samuelson that a market economy lacks I'm quoting, an internally efficacious mechanism for adjusting aggregate supply to aggregate demand at an optimal level of output and employment. So I start from that position. I draw from this the conclusion that public intervention is necessary to bring about such a balance. But further, I conclude that the proper regulation of employment and investment in the economy is a matter of policy for government, not the central bank. In short, macro policy needs to secure, in fact, the macro policy needed to secure such a balance can't be left to central banks. So those are the propositions which I start with. We've begun to inch back to fiscal policy after decades of central bank dominance. The failure of monetary policy to prevent the great financial crash of 2007-2008 and the relative failure of quantitative easing to provide the required boost to prices and output since 2008 has come as a deep intellectual and political shock. The toolboxes of central banks are almost empty, their presidents declare, as their balance sheets swell uncontrollably. Orthodox theory struggles to explain why so many millions of dollars and pounds and euros of QE money are stuck in negatively priced assets. Retiring ECB President Mario Draghi admits that monetary policy, I'm quoting, needs help from fiscal policy, echoed by incoming President Christine Lagarde, who says exactly the same thing. Secular stagnationists like Larry Summers have taken to arguing that the rate of return on capital in the United States has fallen so low that only public investment can revive the American economy. Coinciding with disappointment with monetary policy has come a much more positive reading of Obama's fiscal boost of 2008 and 2009, and a much more negative reading of Europe's post-slump fiscal austerity. A notable turning point was Olivier Blanchard's rehabilitation of fiscal multipliers in 2013, reinforced this year with his classic understatement that fiscal policy has been somewhat underused as a cyclical tool. Also, it was realized that central bank bailouts in 2008-2009 were fiscal, not monetary operations. It was not central bankers who saved the world in 2008. It was politicians who authorized them to pump money into the financial system at the public expense. Contrary to the standard view of 20 years ago, monetary policy is not generally viewed as a weak support for economic growth and stability. However, no agreed basis exists for future macro policy, and that is my theme. Indeed, the way fiscal policy is being edged back now is bound to discredit its use in the future. UK Chancellor of the Exchequer, Sajid Javid, has thrown his predecessor's painfully constructed fiscal rules into the dustbin. As Paul Johnson, director of IFS, points out, setting supposedly binding fiscal rules, missing them, abandoning them, and replacing them with something new harks back to the bad old days of the political business cycle. The unexplained failure of monetary policy to reignite vigorous growth has led to the revival of bribery Keynesianism. But to try to steer the economy without a theory and without a policy anchor is, of course, disastrous. My proposition tonight is that we should reinstate fiscal policy in a non-discretionary way. But I won't produce this particular rabbit out of my hat till I've prepared the ground. First, I want to outline pre-crash orthodoxy as I see it. Then I will argue that it failed as theory and that monetary policy failed in practice to state the economy both before the crash and after the crash. And the final part of my lecture, I will state the case for reinstating fiscal policy, but in a way which I hope may avoid the mistakes of the past. So that's going to be the structure of my talk. First, the chief elements in the pre-crash macro-orthodoxy were: 1, the belief in optimally self-regulating markets. This is associated with the rational expectations revolution of the 1970s and the work of Robert Lucas and Thomas Sargent and their colleagues, which won the Nobel Prize, provided a theoretical underpinning for the Thatcher-Reagan labour market reforms of the 1980s. Eugene Farmer is another notable name here. His efficient market hypothesis, coming from the same geographical and intellectual space, Chicago University and its environs, rationalized financial deregulation and fueled the growth of shadow banking as giving a promise of uninterrupted liquidity. A second element was the restriction of the state's investment function through privatization of the commercial public sector. The general argument was Ricardian. Public investment was bound to be wasteful because if the private sector wasn't doing it, it couldn't be profitable. A standard conclusion from this type of analysis was that governments shouldn't interfere with the allocation of capital. A complementary third strand was reversion to the Victorian idea that budgets should be balanced at the lowest possible level of taxes. Economies grew fastest, it was said, when money was left to fructify in the pockets of the people. Balanced budget rules were needed to ensure the sustainability of the public debt and stop governments financing its spending by printing money. Fourth, the only macro policy that needed to be done was inflation control. Recall Nigel Lawson's seminal lecture of 1984. It is the conquest of inflation and not the pursuit of growth and employment which should be the objective of macroeconomic policy. Following Milton Friedman, the orthodox expectation was that if inflation was controlled, economies would normally be stable at their natural rate of unemployment. If this rate was considered socially unacceptable, then markets and product markets, you don't pump more money into the economy. Fifth, and following in Friedman's footsteps, it was believed that monetary policy was more effective than fiscal policy. The economic argument was that fiscal policy operated only with long and variable lags, so that government interventions were always bound to be wrongly timed. But a much more powerful political economy argument was that stabilization policy carried out by central bank technocrats would be politically neutral. In contrast, the vote-seeking propensity of politicians would infallibly lead them to inflate the economy by running budget deficits at full employment. So that's the orthodoxy. 1976 marked the point of transition from Keynesian fiscal to Friedmanite monetary policy in this country. It wasn't all done immediately, but it was the start, the watershed. In the following passage, written as is well known by the then Friedmanite, by his Friedmanite son-in-law Peter Jay, the then Prime Minister James Callaghan, Labour Prime Minister, told the Labour Party conference in 1976, "We used that you could spend your way out of a recession and increase employment by cutting taxes and boosting government spending. I tell you in all candour that that option no longer exists, and that insofar as it ever did exist, it only worked on each occasion since the war by injecting a bigger dose of inflation into the economy, followed by a higher level of unemployment as the next step. Higher inflation followed by higher unemployment. That is the history of the last 20 years. very well-known speech. The two speeches, absolutely key. Nigel Lawson comes later, 1984, Jim Callaghan, 1976. This is when policy starts to shift. And economists will recognize this as the death knell of Phillips curve Keynesianism. Now, I start with this history deliberately, not just as someone whose academic background was in history. The stories we tell ourselves about the past, however inaccurate or incomplete, strongly influence the way we think about the present and the future. That's why a proper scholarly revisiting of the fateful years 1968 to 1975 must be part of any serious effort to rehabilitate fiscal policy. You will be surprised to learn, perhaps, that far from being subject to the inherent deterioration described in Callaghan's 1976 speech, the average inflation rate in the United Kingdom was lower in the 1960s than it had been in the 1950s. Lower, not higher. And in the United States, lower in both the 1950s and 1960s than in the 1990s. Thus, what's sometimes called the fiscal theory of inflation, the theory that government would always use inflation to meet its budget constraint, is at the very least greatly exaggerated. Although inflation was starting to creep up at the end of the 1960s, it really only took off in the 1970s under the influence of a coordinated world commodity boom, which the first oil price shock, and the breakdown of the international monetary system. In short, there is something fundamentally wrong with Friedman's narrative of the great inflation. We may agree that fiscal policy became in the end overburdened without feeling that we needed to throw out the baby with the bathwater. We need to replace the prejudiced Friedmanite story with a more accurate narrative of what went wrong with the Keynesian revolution. Because something did go wrong. So, I come to a second section, monetary policy during the Great Moderation and after. Monetary policy has had a prolonged trial from the 1980s to today. Lack of time prevents me displaying the detailed evidence of its performance, which I do in my highly recommended book, Money and Government, which you can see outside the room. So I merely assert the conclusions from the evidence. First, the Bank of England's achievement of its target rate of inflation during the Great Moderation, we're talking of the 1990s leading up to 2007, was down more to good luck than good policy. It benefited from what Mervyn King, the governor in the latter part of the period, called a benign environment, in which inflation was being kept down mainly by low-cost labour competition from East Asia, Latin America, and the former socialist countries. Further, in congratulating themselves on their success in maintaining price stability, central banks were blind to the financial instability being engendered by the explosion of securitization and shadow banking. Second, post-crash experience, this is pre-crash experience, post-crash experience has shown that though monetary policy may have some influence in cooling down overheating economies, it has much less influence in warming up chilled ones. Since 2009, we've had 3 periods of unconventional measures, quantitative easing, in 2009-10, 2011-12, and since 2016, which have injected almost £500 billion of high-powered money, or roughly, into the economy, or roughly 25% of 2012 GDP. Despite these injections, the Bank of England has fairly consistently undershot its pre-crash inflation target, and more importantly, failed to raise economic growth back to its pre-crash trend. A crucial indicator of this was the failure of repeated injections of high-powered money to bring about the revival of broad money. The money multiplier seemed to be broken, if indeed it ever did exist outside the realm of theory. To this day, large corporations are sitting on hordes of cash. It isn't lack of liquidity that's stopping them from investing, but lack of demand. Now, the defence offered by the Bank of England is that the situation would have been worse had there not been QE. That's surely true. Given the disablement of fiscal policy, monetary policy was the only game in town. And the Bank of England did all that it could to keep the British economy afloat. But the problem was that its stimulative power was very limited, as has only belatedly been recognised, and it didn't really ask the question, could fiscal policy have done better? Now, I've now turned, so the evidence for that failure is there in a longer version of this, but I haven't time to go through it. But I want to turn to the question of the theoretical weaknesses of monetary policy, because I think this really engages very much with Tim and with many other people who would argue for the power of monetary policy. The mediocre results achieved by monetary policy point to one key theoretical weakness, the scant attention paid to what Keynes called the speculative demand for money. The mischief can be traced back to Friedman's discovery of a stable demand for money balances, a stable demand for money balances. The theoretical assumption underlying quantitative easing was that the injection of cash into the economy would raise both price and output levels, both. There was no entirely coherent theory, in my view, of how this was supposed to happen. In the simple theory, expectation of higher prices would produce higher output by improving business confidence. This was the story told by Keynes in his tract on monetary reform, and it seems to me the most plausible account of how monetary expansion might work to raise output and prices. The simple theory, however, was subsumed by a more complicated transmission mechanism, according to which QE would lead to increased business investment by, on the one hand, reducing bond yields, the bank lending channel, and on the other hand, by raising asset prices through a wealth effect which would feed through mainly into higher consumption. But so whatever the exact transmission mechanism was supposed to be, and if you read the Bank of England minutes at the time, and they keep arguing about what it really is, they don't really know what they're doing. Anyway, whatever it is that was, the common ground was that there existed a definite calculable money multiplier. That is, that an expansion of high-powered money would produce a multiplied expansion of broad money after, at most, a very short lag, a few months or so. And it was this absence of the long and variable lags which was supposed to mark the superiority of monetary policy over fiscal policy. In fact, following the crash of 2008, M1 and M4 were not correlated in the way that the money multiplier said they should have been. Why this was bound to be the case is captured in a devastating critique by Keynes in his book, The General Theory. If, however, we are tempted to assert that money is the drink which stimulates the system to activity, we must remind ourselves that there may be several slips between the cup and the lip. What Keynes was saying is that once you introduce time into your analysis, external events are bound to make all our best guesses uncertain. The monetary pump is inefficient because it's too leaky. It pumps too much money into the financial or speculative system, not enough into the real economy, creating an imbalance between the two, which makes financial crashes all but inevitable. And I think we're all waiting for the next one. Now, the emergence of this phenomenon, which used to be called idle balances, balances for which there was no business use, so to speak, as it was believed, was a well-established explanation of business downturns before Keynes. It was stated very clearly by Hawtrey in 1925. When trade is slack, traders accumulate cash balances because the prospect for profit for any enterprise are slight and the rate of interest from any investment is low. When trade is active, an idle balance is a more serious loss and traders hasten to use all their resources in the business. That is a good, succinct statement of why cash balances accumulate when business confidence is low. Now, Keynes took hold of this idea and ran with it. And this is how he ran with it. First, he thought that what he called liquidity preference. He called this speculative demand for money. He called it speculative demand for money. He also called it liquidity preference. He saw it as arising not just in moments of anxiety, but as a normal condition of capitalist economies, given the inherent uncertainty about the future. It is his basic explanation of long-run underemployment equilibrium. Constant liquidity preference, continual liquidity preference as a drag, permanent drag on economic activity. Secondly, he thought of the rate of interest as the price of dishoarding, not the reward for saving. Savings shouldn't therefore be treated as loanable funds. Third, in the absence of official intervention, the liquidity premium attaching to money would prevent the establishment of a long-run rate of interest consistent with full employment. The rate of interest could not therefore be treated as the variable that brings the macroeconomy into equilibrium. Fourth, Keynes clearly distinguished between the cost of capital and the demand for capital. Central bank policy can influence the financing of credit, but not the decision to invest, which depends on expected returns from investment. QE adds to the liquid reserves of banks and corporations, but it doesn't automatically reduce the risky lending rate of interest or increase the marginal efficiency of capital. And one final point, which isn't central to Keynes, but I think is central to this discussion. Leaving stabilization to central banks also ignored the distributional consequences of modern financial capitalism. Karl Marx, I now cite, the last cause of all real crises always remains the poverty and restricted consumption of the masses as compared to the tendency of capitalist production to develop productive resources. Now, a common assumption was that by raising asset prices, quantitative easing would automatically generate the wealth effect of increased consumption. But given the different class propensities to consume, this effect turned out to be too small to stabilize consumption, with much of it devoted to speculation in non-currently produced assets. While the top 10% gained 350,000 in wealth between 2006 and 2014, the poorest 10% gained 3,000 only, and much of the rise in wealth inequality is down to the Bank of England's asset purchasing policy. So, summing up this line of argument, the quantity of money is not an independent variable. It depends on business expectations, and those depend on having consumers at the door. So, what is to be done? As Lenin once said, what is to be done? The post-crash consensus is that we will have fixed the pre-crash problem of reckless bank lending by adding financial stabilization to monetary policy. Central banks should become market makers of the last resort. Provided we can regulate the banking system properly in all kinds of ways, we will have rediscovered the secret of stability. We will have added a crucial extra tool to monetary policy, which will prevent a repetition of the events of 2007, 2008. So what we want to do is to expand the functions of the central bank, to make it responsible for macroprudential regulation and other things. Now, one major problem with such proposals is that it legitimacy. In his book, Unelected Power, 2000, this came out this year, Paul Tucker, was a deputy director of the Bank of England all through this time, endorses the case for delegating macro policy to technicians, and that his case is based on the lack of credible commitment, I'm quoting him, by politicians to govern in the public interest. So given that politicians are not credible as managers of the public interest, what we need, he says, is to agree rules of delegation. This translates the problem of macro policy into one of institutional design. However, Tucker fails to solve the problem he has set himself. He rightly points out that delegation of functions is not sufficient, since credible commitment problems, and I'm quoting him, run right through so many areas of government that it might justify government itself being delegated to a platonic guardian. He almost says that if you don't trust elected politicians to act at least sometimes in the public interest, you might as well give up on democracy. So this is the dead end, it seems to me, in which this kind of discussion leads. And Tucker is a thoughtful representative of those who, while recognizing legitimacy problems in delegating monetary policy to unaccountable technicians, never confront the theoretical flaws of relying on monetary policy to stabilize the economy. It's all a matter of how you do the institutional arrangements to make monetary policy more effective. Even though they wouldn't accept in any simple form the doctrine that market economies managed and regulated by independent central banks are naturally stable, their thinking naturally gravitates to this kind of conclusion, this kind of Friedmanite conclusion. If they now accept that monetary policy may be overburdened, they have not shed their mistrust of entrusting macro policy to politicians. The choice they offer is between an overburdened technocracy and an overburdened democracy. Is there any escape from this dilemma? So I want to consider that question in the last part of my lecture. First point, any reinstatement of fiscal policy has to start with a clear theoretical view of why we need macroeconomic policy. Why do we need it? The Keynesian answer is that unmanaged market economies have three interrelated faults. A, their normal or long-run outcome is underemployment equilibrium. B, they are cyclically unstable. And C, they generate growing inequality, which intensify the first two faults. So-called new Keynesians accept the macroeconomic framework of the anti-Keynesian rational expectation school, but argue that because prices and wages are sticky, there is a policy exploitable short-run Phillips curve, and that is the new Keynesian argument for macro policy. Short-run, the existence of a short-run Phillips curve, really. Now, two, if macro policy is required, should it be done mainly by monetary or fiscal policy? The limitations of monetary policy were made clear by events, in my view, the events leading up to the 2008 crisis, but more emphatically since the crisis, because instability of the financial system under the control of central banks before 2007-8 has led to has been followed by an incomplete recovery. Central banks simply do not control money in the way envisaged by monetarists, or new Keynesians, because they have only an indirect influence on the demand for credit. Attempts to broaden their mandate by arming them with extra and partly fiscal functions run into crises of legitimacy a la Tucker. If fiscal intervention is needed, central banks and the agencies to undertake it. 3. However, some work is needed before fiscal policy can be made serviceable. And I take this very seriously. We have been deluded by the magical power of numbers. 3% annual deficits, 60% debt GDP ratios, 90% cliff edges. Where do all these figures come from? I know where they come from. They were actually what was going on at the time. And they were, but they haven't got a theoretical justification. These attempts to fix the numerator while ignoring the denominator are like fixing the thermometer at just one temperature. In drawing up its fiscal rules, governments should take account of the asset as well as the liability side of its balance sheet, as urged by Richard Hughes, head of fiscal policy at the Treasury. Put very simply, recognizing the value of aircraft carriers or railways would give, or HS2 would give governments scope to increase spending on infrastructure. And that in turn would restore some investment respectability to the budget. Because it's becoming increasingly clear that an economic system in which investment is mainly private, in which monetary policy fails to deliver, and in which government is denied a stabilizing investment role, is very dependent on fluctuations in the news and rumor. And that's what we're seeing the whole time. I mean, we're living in an era of uncertainty. But what's new? We've always been living in an era of uncertainty. It's just a matter of lesser or greater uncertainty in any period. We have great uncertainties now because of Brexit. But uncertainty is endemic in any future-oriented, forward-looking system. And that's the problem that has to be confronted. And the 5th point, such rethinking should lead us to consider ways in which fiscal policy might be retained, but made more automatic. This is the final point I want to make more automatic, limiting the discretion of politicians to spend as if there was no tomorrow in order to win elections. So I want to focus on the valuable concept of automatic stabilizers. Do something to improve their power. Paul Samuelson writes, the modern fiscal system has great inherent automatic stabilizing properties. When the economy turns down, government tax receipts fall and spending on unemployment benefits and other transfers rise, creating an automatic deficit which offsets all in private spending. Or in national accounting terms, offsets the rise in private saving. When the economy recovers, the budget automatically rebalances. To preserve this inbuilt stability, no attempt should be made to balance the budget in a downturn. I mean, this was the theory of the automatic stabilizer, and it is accepted. It was obviously part of the response to the slump. However, as Samuelson noted, a built-in stabilizer only deals with part of the problem. It deals with part of the disturbance. It doesn't deal with the whole disturbance. And if discretion is the problem, then the policy problem is the problem. The task we face is to strengthen the automatic stabilizers at the expense of the discretionary policy. How do we do it? There are 2 ways of doing it. The first is to revive the state's long-run investment function. Since the 1980s, public investment as a share of total investment has collapsed. It's running about 20%, 25% in the 1950s and 60s. It's now down to 5%, 6%. So the weight of maintaining investment, really, or virtually the whole weight, has fallen on the much more volatile private sector. So what is the argument for strengthening the state's investment role? Well, Adam Smith recognized, it goes back to Adam Smith, recognized a public goods argument for permanent public investment. But in addition, as has often been pointed out, the large share of public investment in total investment in the Keynesian age had a stabilizing effect, offsetting the inherent volatility of private investment and fulfilling Keynes's claim that the state is in a position to calculate the marginal efficiency of capital goods on long-run views and on the basis of the general social advantage. So Keynes claimed for state investment a stabilizing role in the performance of the economy. It acts as a long-term automatic stabilizer. It's directed to the long term and should be segregated from the state's current spending and insulated from management of the cycle. And we can think of ways in which public investment can be done, either directly by the state or through off-budget investment institutions. Now for my rabbit. For counter-cyclical purposes, I advocate a public sector job guarantee. PJP, I'll call it for short. This would have the advantage of automaticity by depriving politicians of discretion over counter-cyclical policy, and would also be a much more powerful automatic stabilizer than the system described by Samuelson, because it would leave a much smaller role for discretionary policy to deal with what he calls the rest of the disturbance. I see it as the modern way of honouring the Keynesian full employment commitment. Now, far from being a revolutionary innovation, PJP is an outgrowth of public works programs used by all pre-Keynesian governments to limit unemployment in a downturn. Its rationale was succinctly stated by the US National Commission on Technology, Automation and Economic Progress in 1966, and I want to quote here: "With the best of fiscal and monetary policies, there will always be those handicapped in the competition for jobs by lack of education, skill, experience, or because of discrimination. The needs of our society provide ample opportunities to fulfill the promises of the Employment Act of 1946, a job for all those able, willing to seek work." And so they recommended that be done, but it wasn't. The Humphrey-Hawkins Act of 1976 introduced an additional argument which is very pertinent to what I want to say. It authorized the US federal government to create a reservoir of public employment to balance fluctuations in private spending. The reservoir would automatically deplete or fill up as the economy waxed or waned, creating an automatic stabilizer. No management of the business cycle was involved. But of course that act was never implemented. Put simply, the government should guarantee a job to any job seeker who cannot find work in the private sector at a fixed hourly rate which would not be lower than the national minimum wage. I mean, that is the proposal. For justification, I draw heavily on American literature because it's not really familiar in the current British discussion, but it has become a lot more familiar around the world. And you have these public sector job guarantee programs in Argentina, in India, in Denmark, in Hungary, where it's been most extensively tried. These are the justifications. PJP would target not aggregate output, but labor demand. This eliminates the problem of having to calculate output gaps. It is less analytically complicated to target employment than output. Definition of full employment can be made quite precise and uncomplicated. It exists where all those who are ready, willing, and able to work are gainfully employed at the base wage. 2, The PJP pool acts as a labour buffer stock, which expands and contracts automatically with the business cycle, eliminating discretionary fiscal policy. I've already mentioned why that is the case. 3. PJP workers would be paid at a fixed rate. This can be set at any level the government wants above unemployment benefit. Typically, advocates of PJP suggest a living wage, but all it needs to be for enhanced stabilising purposes is higher than unemployment benefit. A fixed wage sets a floor for private firms' wages. If the PJP wage was set at the national minimum wage, no minimum wage legislation would be necessary. Since private employers would always have to pay at least the PJP wage if they were to attract workers. And in periods of rising demand, they'd have to pay above the PJP wage. By eliminating the pool of involuntarily unemployed and underemployed workers, that is, by making labour scarcer than it would otherwise have been, PJP substitutes an upward for a downward pressure on wages. It thus brings a single instrument to bear on the twin problems of unemployment and inequality. PJP advocates attach great importance to Keynes's stress in 1937 on the need of a rightly distributed demand more than a greater aggregate demand. Because, you know, a satisfactory average level of employment can be consistent with some parts of the economy overheating and other parts seriously underheating. The implication of this stress on a rightly distributed demand is that orders for work should be placed in areas experiencing or most vulnerable to high unemployment. 5th point, consistently with this, PJPers insist that the programmes, while funded centrally, should be administered locally by a variety of local agencies, both voluntary and local authorities. Now, 2 objections, commonly advanced and almost immediately advanced, without anyone, when they're first confronted with this kind of idea. The first is that it would be inflationary. The second is that it would create pretend jobs. In turn, I've argued that the automaticity of the programme makes it less prone to be inflationary than discretionary management of the business cycle. In this context, the NERU, or the non-accelerating rate of unemployment, is not a relevant concept. As long as there's underemployment of labour, job guarantee which removes the underemployment can't be inflationary. But, of course, if you're worried about inflation, then, of course, you can also set the government a target or a mandate, which is to raise taxes automatically with any increase in inflationary pressure. That could be a mandate, part of a fiscal constitution. Well, we're used to mandates. This would be, they couldn't break it. Central banks, well, they would of course still have an important role, but their role to me would be to prevent the private sector. Their role to me would be to maintain financial stability and a quantity of money consistent with the government's full employment policy, that is, a yield curve, consistent with government full employment policy. A second common objection to PJP is that it's bound to be pretend work, in the spirit of paying people to dig holes and fill them up again. I think we also need a less jaundiced historical narrative about the record of these public works, which draws on the achievements of such American New Deal programs as the Works, Progressive Administration and the Civilian Conservation Corps. And, you know, I think Keynes is, there are all kinds of things, I can't go into them, that these programs did, including conservation, renovating local communities, all kinds of things which are very far from being pretend work. But I want to just quote one ironic comment on this by Keynes. He said of those who condemned the public works programs of his day as waste, he wrote, "It's curious how common sense has been apt to reach a preference for wholly wasteful forms of loan expenditure, represented by unemployment relief, than partly wasteful forms, which, because they are not wholly wasteful, tend to be judged on strict business principles." So I've done a model, and on the conservative assumption that a public sector job will pay double unemployment benefit, a public job guarantee would halve the negative impact of any given collapse of private sector demand. In the example I've worked with, the immediate fall in aggregate income is 8% under unemployment benefit scenario, whereas it's limited to only 2% under the public job guarantee scenario. For those interested in the justification of this estimate, a simple technical appendix I can make available. So, I conclude. This lecture has argued for 5 propositions: that an unmanaged market economy is cyclically unstable and liable to settle down to a long-term underemployment equilibrium, that public intervention is required to maintain continuous full employment, that fiscal policy is a more powerful tool to achieve this than monetary policy, that a method of fiscal intervention is needed which avoids the discretionary element in old-style Keynesian demand management, and that the contemporary method of such intervention is a mixture of long-run investment programs and short-run job guarantee programs. Thank you.